Welcome to our comprehensive analysis of Evolution AB as we look toward 2026. Evolution isn't just a gaming company, it is the backbone of the global live casino industry. For ambitious investors, understanding this B2B giant is crucial. Unlike traditional operators, Evolution provides the infrastructure, the dealers, and the technology that power the world's biggest betting brands. As we enter this decade's midpoint, the shift from land-based to online gaming continues to accelerate, placing Evolution in a unique position to capture a massive total addressable market. Today, we will break down their revenue growth, the incredible margins that keep competitors at bay, and what the valuation looks like for 2026. Let's dive into why this company remains a top pick for strategic economic growth. By 2026, Evolution's revenue mix is expected to diversify further. While live casino remains their crown jewel, representing over 80% of current revenue, their strategic push into RNG, or random number generator games, is the key to unlocking new demographics. We are seeing a massive expansion into North America and Asia, where digital adoption is skyrocketing. Evolution's ability to release over 100 new games annually ensures that their content library remains fresh and engaging for players. This high-volume release strategy, coupled with entry into newly regulated states in the US, provides a multi-layered growth engine. We are projecting a sustained revenue CAGR that outpaces the broader tech sector, driven by both organic innovation and tactical acquisitions. What truly sets Evolution apart is its financial efficiency. We are looking at EBITDA margins that consistently hover around 69% to 71%. This level of profitability is almost unheard of in the service sector. How do they do it? It's the scale. Evolution operates massive studio hubs in Latvia, Malta, and North America, where a single table can serve thousands of players simultaneously. This one-to-many business model allows for immense operating leverage. As they scale, the costs don't rise linearly with their revenue. For the 2026 outlook, we expect these margins to remain stable or even expand slightly as they optimize their RNG segment and leverage AI for game integrity and operational efficiency. In the world of B2B, the moat is built on trust, scale, and technical superiority. Evolution holds licenses that are difficult and expensive to obtain, creating a high barrier to entry. Their network effect is significant. The more operators use Evolution, the more data they gather, and the better their games become. By 2026, their technological lead in low-latency streaming and augmented reality game shows like Crazy Time will be even harder for competitors to replicate. They aren't just competing on price, they are competing on the quality of the user experience. This brand equity allows them to maintain premium pricing power with operators, ensuring long-term contract stability and a defensive position against smaller startups. Now, let's talk valuation. Currently, Evolution trades at a PE ratio that often fluctuates between 15x and 25x. Given their 20% plus growth rate, many analysts consider this undervalued compared to US-based SaaS companies. By 2026, if Evolution maintains its 70% margins and hits its revenue targets, we could see earnings per share, EPS, nearly doubling from 2023 levels. Our conservative 2026 price target assumes a 20x multiple on projected earnings, which suggests a significant upside for current investors. However, we must account for the Sweden discount, the tendency for European stocks to trade at lower multiples than their US counterparts. Even with this, the risk-to-reward ratio remains highly attractive for those focused on long-term wealth management. No investment is without risk. For Evolution, the primary headwind is the regulatory environment. Changes in gambling laws in major markets like the UK or Germany can impact bottom-line results overnight. Additionally, there's the gray market risk, revenue derived from jurisdictions where online gaming is neither explicitly legal nor illegal. As we head toward 2026, Evolution is actively working to shift more of its revenue to regulated markets to mitigate this. We also have to monitor the competitive landscape. While Evolution is the leader, companies like Playtech and Pragmatic Play are investing heavily to close the gap. Investors should keep a close eye on any margin compression that might signal a pricing war. Evolution's strategy into 2026 involves more than just organic growth. We expect them to remain aggressive in the M&A space. Following their acquisitions of NetEnt, Red Tiger, and Big Time Gaming, Evolution has proven they can integrate specialized studios to bolster their RNG portfolio. The next frontier could be social gaming, or deeper integration into the metaverse and VR casino experiences. Their massive cash pile, aided by that 70. To wrap up, Evolution AB remains a top-tier growth story with the financial profile of a mature value stock. Its dominant market position, industry-leading margins, and clear 2026 roadmap make it a compelling case for any portfolio focused on strategic economic growth. While regulatory risks persist, the company's track record of execution is unparalleled in the iGaming space. For the ambitious professional or individual investor, Evolution represents a play on the digitalization of entertainment. Keep an eye on the quarterly reports for margin stability and U.S. market share gains. Thank you for joining this deep dive. If you found these insights valuable, ensure you are tracking these metrics as we move closer to 2026.